Every second, global markets shift, and one of the most powerful forces behind those movements is news. Whether it's a government policy announcement, a corporate earnings report, or a sudden geopolitical event, the information reaching traders and investors directly influences their decisions. In this video, we'll explore how news drives stock prices, triggers emotional reactions, and creates massive opportunities or risks in financial markets. 1. The immediate impact of breaking news. Markets thrive on information. When breaking news hits, especially unexpected news, it creates immediate reactions in stock prices. This is known as price discovery. Traders and algorithms digest the news within seconds, and prices adjust based on perceived impact. For example, if a company announces better than expected earnings, the stock price usually jumps. On the other hand, if there's a report of fraud or executive scandal, it could trigger a sharp drop. The faster the news spreads, the quicker the market reacts. In today's digital age, this reaction time has shrunk to milliseconds, thanks to high-frequency trading algorithms that scan headlines and execute trades before a human even finishes reading. 2. Sentiment-driven volatility. Not all market reactions are logical. Many times, news affects stock prices because of investor sentiment, not hard data. Headlines create emotions, fear, optimism, panic, which drive buying and selling. Positive news about the economy might cause investors to rush into stocks, even if the data doesn't fully support the hype. Similarly, bad news, even if temporary or exaggerated, can trigger panic selling and massive drops. Emotional investing causes overreactions, leading to short-term volatility. Smart traders look for these emotional swings as opportunities to enter or exit positions. 3. Scheduled news events and market expectations. Some news doesn't surprise investors. It's scheduled. These include central bank announcements, inflation data, jobs reports, and corporate earnings. But even here, markets react strongly, not to the news itself, but to whether it meets, exceeds, or falls short of expectations. Let's say investors expect inflation to be at 3%. If the report shows 2.8%, markets may rise. If it's 3.5%, they might fall, even though both numbers are close. Why? Because the market price and the expectation, not the actual number. This expectation gap creates tradable events, where savvy traders position themselves ahead of the release or react quickly once the data drops. 4. How media framing shapes market reactions. The way news is presented, positive or negative, shapes how investors react. Two headlines about the same event can drive opposite emotions in the market. One might frame a company's cost-cutting as strategic efficiency, while another paints it as financial distress. Investors often react to the tone more than the facts, which creates volatility. Recognizing media bias helps traders interpret the real impact of the news. 5. Fake news and misinformation in trading. Markets have reacted to false news before, be it a misleading tweet or viral rumor. These fake headlines can cause panic buying or selling within minutes. That's why verifying information from credible sources is critical. One wrong move based on fake news can result in big losses. 6. The role of social media in market movement. Social media platforms like X, formerly Twitter, Reddit, and YouTube have become unexpected sources of market-moving news. One viral post or trend can lead to a buying frenzy or a sudden sell-off, especially among retail traders. The GameStop short squeeze in early 2021 is a prime example. A grassroots movement on Reddit created a wave of buying that shook Wall Street. Since then, traders monitor social media just as closely as traditional news outlets. Social sentiment analysis is now a core strategy, with algorithms scanning platforms to detect trends, hashtags, or spikes in discussion volume. 7. Long-term news themes that shape markets. Not all news has a short-term effect. Some stories create long-term themes that gradually shift entire sectors. Think about climate change policies, AI breakthroughs, or changes in interest rate policy. These stories shape investor outlook over months or even years. For example, continuous coverage of AI advancements has boosted tech stocks. Similarly, long-term inflation concerns drive investment into commodities and value stocks. Investors who recognize these evolving narratives position themselves early, reaping rewards as the trend unfolds over time. 8. How traders use news strategically. Professional traders don't just react to news, they prepare for it. They create calendars of key events, study past market behavior under similar conditions, and set alerts for specific news triggers. Some even specialize in news trading, making fast decisions based on headlines, using tools like news feeds, squawk boxes, and sentiment dashboards. They use tight risk controls because they know markets can swing in both directions, especially during high-impact events. Successful news trading blends preparation, speed, and psychology. It's not about reading the news. It's about understanding how others will react to it. Conclusion: news moves markets, but interpretation is everything. In the world of stock trading, news is more than information. It's a trigger, a signal, a catalyst. From breaking headlines to scheduled reports, from social media buzz to long-term narratives, every bit of information holds the power to shape investor behavior. But the smartest traders aren't just reading the news. They're reading the reaction. They understand that it's not the headline itself, but how the market interprets it that drives prices up or down. So if you're trading, don't just follow the news. Analyze it, challenge it, and use it strategically. Because in this game, information is power, but understanding is profit. If you found this breakdown helpful, make sure to like the video, share it with other traders, and subscribe to the channel for more insights into market psychology and trading strategies.